Welcome back to Flexify 2, your job search evolved. I'm your host, Trina. And listen, I've been away for a little bit, but I'm back on the scene to keep you informed. And boy, do I have a lot to unpack for you today. Federal Reserve Chair Jerome Powell dropped an absolute bombshell that's about to shake up every single job seeker strategy. We're talking potential rate cuts hitting as soon as this month, and this could completely transform your career prospects overnight. Last month at Jackson Hole, Powell delivered what many are calling his clearest signal that the Fed is ready to ease its grip on interest rates. But what does this really mean for you if you're job hunting, worried about layoffs, or trying to figure out your next career move? Today, I'm breaking it all down, the opportunities, the risk, and what you need to do right now to position yourself for what's coming. So let's jump in. At the Fed's Jackson Hole Symposium, Powell dropped some serious hints. He said the downside risks to employment are rising and that conditions may warrant interest rate cuts. In Fed speak, that's practically shouting. The market response was immediate. Stocks rallied, and the probability of a September rate cut jumped from 67% to 88% overnight. But here's what really matters for your career: the job market data that spooked Powell. July saw just 73,000 jobs added, way below the expected 110,000. Even worse, previous months got slashed dramatically. May's job growth was cut from 144,000 to just 19,000. June dropped from 147,000 to only 14,000. The 3-month average for job creation has plummeted to just 35,000 jobs per month, down from 168,000 earlier this year. That's not just a slowdown, that's a cliff. If you're actively job hunting, here's your reality check. The market has definitely cooled, but it's not dead. Companies are being more selective, taking longer to fill positions and prioritizing essential roles over nice-to-haves. Entry-level positions and speculative hires are getting cut first. The days of easily jumping jobs for 20% raises are largely over, at least for now. If rate cuts happen and work as intended, we could see a surge in hiring by early 2026. Companies that have been holding back on expansion due to high borrowing costs could suddenly find growth investments attractive again. Focus on recession-resistant sectors like healthcare, essential services, and government. Look at smaller companies such as startups that might benefit more dramatically from cheaper capital. And network aggressively. In tight markets, who you know matters even more. If you have a job, this is actually a mixed blessing. Yes, the slower hiring market means fewer opportunities to jump ship, but it also means your company is probably more focused on retaining talent than replacing it. We're already seeing companies shift from the external hiring to internal development. This could be your moment to push for that promotion, additional training, or expanded responsibilities you've been wanting. But stay alert. While mass layoffs haven't materialized, job security isn't what it was a year ago. Make sure you're adding clear value and good relationships with key stakeholders. The silver lining here: if you're in construction, real estate, financial services, or tech sectors that have been hammered by high rates, relief could come quickly if the Fed starts cutting. Here's something most people miss. How the stock market reacts to rate cuts can directly impact your job prospects, especially if you work for publicly traded companies. Stocks have already rallied on Powell's hints. Interest rate-sensitive sectors like REITs, aka real estate, and utilities popped immediately. Growth stocks, particularly in tech, also benefited because lower rates make their future profits more valuable today. But here's the key insight. Much of this good news is already baked into the stock prices. Many times when the market rallies, it's already priced in. The real test will be whether companies actually use cheaper capital to expand and hire, or just boost their profit margins. If you're investing your own money, don't chase the rate cut blindly. You could consider value stocks and dividend payers that could see sustained benefits. And if the dollar weakens as expected, international investments might become more attractive. This month's Fed meeting is now seen as almost certain to deliver the first cut, probably about 25 percentage basis points. Markets expect additional cuts through 2025, potentially bringing the rates down from the current 5.5% range to somewhere around 3.5 to 4.5% range. But here's what could derail this whole plan. Rate cuts could reignite inflation. If that happens, the Fed might have to slam on the brakes again, creating even more job market volatility. The cuts might not work. If consumers and businesses are genuinely worried about the future, they might not respond to cheaper borrowing costs by spending and investing more. And global complications. Currency swings, trade tensions, or international crisis could force the Fed's hand in unexpected directions. The most concerning scenario would be rate cuts that prove insufficient to prevent a downturn, forcing even more dramatic action later that ultimately proves inflationary. So let me get practical about what we should be doing right now. If you're job hunting, expand your job search to include smaller companies such as startups that might benefit from rate cuts. Prepare for potentially longer search times, but don't panic. And focus on networking. Personal connections become crucial in slower markets. And consider temporary or contract work to stay active and building new relationships. Now, if you're on the other side and you're employed, now's the time to focus on skill development rather than job hopping. Have conversations with your manager about growth opportunities. And review your debt situation. Variable rate debt could get cheaper, but job security might be less certain. And build your emergency fund if you haven't already. And holistically for everyone, watch the data closely over the next few months. Job reports, consumer spending, and business investment. Don't make any major financial commitments based on assumptions about where rates are going. And keep your options open and your skills sharp. Now, if you're in rate-sensitive industries like real estate, construction, or financial services, start positioning yourself for the potential upturn, but don't count on it happening immediately. Here's my take on what's most likely to happen. Let's say the Fed cuts rates modestly starting in September, this month, providing some economic support without creating any new problems. The job market stabilizes rather than collapses, but competition for good positions remain intense through early 2026. The key insight is that monetary policy alone won't solve structural job market challenges. Rate cuts can provide support and buy time, but they can't address issues like skills mismatches, geographic imbalances, or industry disruption. Your success, whether you're job hunting or trying to advance in your current role, will still depend primarily on the fundamentals: relevant skills, strong relationships, clear value proposition, and smart financial management. The Fed's potential pivot is significant news, but it's not a magic solution. Stay informed, stay flexible, and remember that the most important career decisions are usually the ones you make consistently over time, not dramatic reactions to economic headlines. The opportunity is real. If rate cuts work as intended, we could see renewed business investment and hiring by early 2026. But success will go to those who are prepared when that window opens. That's your 15-minute briefing on what Powell's rate cut signals mean for your career and your money. I'll be watching this month's Fed meeting closely. Keep flexifying your job search strategy, stay adaptable, and remember, when the market shifts, the prepared prosper. Don't just survive the change, honey, thrive in it. Thanks for tuning in to Flexify 2 Your Job Search Evolve. I'm your host, Trina. And until next time, keep evolving and keep winning. Stay blessed.